Before we begin, a brief but important note. The information provided in this video is for educational and informational purposes only and should not be considered financial, legal, or investment advice. I am not a financial advisor, and this presentation is not an offer or solicitation to buy or sell any financial products. You should consult with a qualified professional before making any financial decisions. Your financial situation is unique, and any decisions you make are your sole responsibility. You know that feeling, right? You open your bank statement and there it is. A $5 monthly maintenance fee, a $10 minimum balance fee, or the absolute worst, a $35 overdraft fee that feels like a punch to the gut for a mistake that might have only been a few cents. Feels like you're being punished for using your own money. Like your bank account is slowly being drained by 1,000 tiny cuts you never agreed to. If you've ever felt that frustration, you are far from alone. In fact, a recent study showed that the average American household pays hundreds of dollars every single year in nothing but bank fees. That's money that could have paid for groceries, a car repair, or a weekend trip, just vanishing into thin air to pay for the marble floors and teller windows at a bank you might only visit once a year. What if you could stop that bleeding? What if you could take back that money and actually have your bank pay you? Not just pennies, but a significant, noticeable amount just for keeping your money with them. This isn't some far-off futuristic idea. It's the core promise of a revolution that's happening right now, quietly, on millions of smartphones across the country. I'm talking about online-only banks. And over the next several minutes, we are going to pull back the curtain on this entire world. We're not just going to scratch the surface. We are going to do a deep, comprehensive dive into the pros and the cons of trusting your money to a bank that doesn't have a single physical branch. My goal is to give you a crystal clear, unbiased roadmap. By the end of this video, you will understand exactly how these digital banks work, where they shine, and more importantly, where their hidden dangers and frustrations lie. We'll cover the good, the bad, and the sometimes ugly truth so that you can decide with total confidence if making the switch is the right move for your financial life. So, is this the future of banking that will save us all from ridiculous fees? Or is it a risky trend that leaves you vulnerable when you need help the most? Let's find out. The single biggest, most compelling reason people are flocking to online banks can be summed up in two words: the money. It's about stopping the fees and starting the earnings. This is their headline feature, their main event, and honestly, it's a game changer. Let's break down exactly why they can do this. Your traditional big-name bank has enormous costs. They have to pay rent on thousands of prime real estate locations, from downtown skyscrapers to corner spots in your local strip mall. They have to pay for electricity, security, maintenance, and the salaries for every single teller, manager, and loan officer in those buildings. It is a massively expensive operation. And how do they cover those costs? A big chunk of it comes from you in the form of fees. Your monthly service fee is helping to pay the electric bill for a branch 1,000 miles away. Online-only banks completely obliterate that business model. Their headquarters might be a single office building in Delaware or Texas. Their branches are their app on your phone and their website on your computer. Their overhead is a tiny fraction of a traditional bank's. And because they save an astronomical amount of money on physical infrastructure, they can pass those savings directly on to you, their customer. So what does this actually look like in your bank account? First, let's talk about the fees they get rid of. The most common one is the monthly maintenance or service fee. For most online banks, that's just gone. It doesn't matter if you have $5 or $50,000 in your account, you're not paying a penalty just for existing. Next up, minimum balance fees. Many traditional banks require you to keep a certain amount, say $1,500, in your checking account to avoid a fee. With most online banks, that requirement disappears. No more anxiety about dipping below an arbitrary threshold. And a big one, ATM fees. While online banks don't have their own ATMs, many of them will reimburse you for the fees other banks charge you. So you can use virtually any ATM in the country. And at the end of the month, that $3 or $4 fee you were charged gets credited right back to your account. When you add it all up, for many people, this can mean saving anywhere from $100 to $300 a year. That's real money back in your pocket. But stopping the bleeding is only half the story. The other half is what they pay you. This is where we talk about the annual percentage yield, or APY. It's the interest your money earns just by sitting in an account. For years, the savings accounts at major brick-and-mortar banks have been a joke. You'll see rates like 0.01% or maybe 0.1%. Let's put that in perspective. If you have $10,000 in a savings account earning 0.01% APY, after an entire year, you will have earned $1. One single dollar. It's an insult. Now let's look at the online banking world. Because their overhead is so low, they can afford to compete for your savings by offering dramatically higher interest rates. It's not uncommon to see high-yield savings accounts from online banks offering APYs of 4%, 5%, or sometimes even higher, depending on the economic climate. These rates do fluctuate, of course, but the gap between them and traditional banks is almost always massive. So let's run that same $10,000 scenario. Instead of earning $1, if your account has a 4.5% APY, after 1 year you would have earned $450. That's the difference between buying a cup of coffee and buying a new set of tires for your car. It's a profound shift in what your savings can do. Your money is no longer just sitting there stagnating. It's actively working for you, generating meaningful passive income, and helping you fight back against inflation. This isn't a gimmick. It's the direct result of a more efficient business model. By cutting out the physical bloat, online banks can offer a mathematically superior product for savers. And for millions of Americans, that simple, powerful math is more than enough reason to say goodbye to their old bank forever. But, as you're about to see, what you gain in dollars and cents, you might be giving up in other critical areas. The story is far from being that simple. The first and most obvious trade-off is the one you see, or rather don't see, right on Main Street. It's the marble columns, the smiling tellers, the lollipops for the kids. It's the very idea of a physical bank branch, and for a generation raised on digital convenience, it might seem like a relic, an unnecessary expense. But the moment you actually need one, its absence can feel less like a modern convenience and more like a critical failure. Let's tell this through the story of someone we'll call Jessica. Jessica is a 29-year-old graphic designer living in Chicago. She's savvy, she's organized, and she's always looking for ways to optimize her finances. When she saw an online bank offering a savings account with an annual percentage yield, or APY, that was 20 times higher than her big, traditional bank, she didn't hesitate. The sign-up process took 5 minutes on her phone. She transferred the bulk of her savings over, and felt a genuine thrill watching the interest accumulate daily. For the first 3 months, it was perfect. The mobile app was slick, transfers were instant, and she was earning real, tangible money on her emergency fund. She felt like she had unlocked a secret level in the game of personal finance. Then reality knocked. It started small. Jessica sold an old piece of furniture on Facebook Marketplace. The buyer, a friendly older gentleman, paid her $400 in crisp $20 bills. Normally, she just stopped by the ATM on her way home and deposited it. But her new online bank didn't have its own ATMs. No problem, she thought. The bank's website said she could use a partner ATM network. She found one at a nearby convenience store. But when she got there, she saw a sign: no cash deposits. She tried another. Same story. After a bit of frantic Googling on the sidewalk, she discovered the official method for depositing cash was to go to a specific retail chain, have the cashier scan a barcode in her banking app, and hand them the money. Felt strange. Handing a pile of cash to a cashier at a pharmacy to put into her bank account felt less secure than a traditional bank deposit. Plus, there was a fee. Not a huge one, just a few dollars, but it felt like a penalty for dealing in the physical world. And there was a daily deposit limit of $1,000. For her $400, it was just an inconvenience. But she immediately thought, what if I were a server, a bartender, or anyone who primarily deals in cash tips? This system wouldn't just be an inconvenience. It could be a logistical nightmare. The first crack in the perfect digital facade had appeared. A month later, a much bigger problem emerged. Jessica found the perfect apartment. The landlord loved her application, but, like many small-time landlords, he required the first month's rent and security deposit in the form of a cashier's check. It's a standard request. A cashier's check is drawn against the bank's own funds, meaning the money is guaranteed. It's a sign of good faith. At her old bank, this was a 10-minute errand. You walk in, show your ID, tell the teller the amount, and walk out with a secure check in your hand. Jessica logged into her online bank's app, confident there'd be a simple digital solution. There was. Sort of. She could request a cashier's check. The bank would print it and mail it to her. The standard delivery time? 5 to 7 business days. She could pay an extra $30 for expedited 2-day shipping. The landlord needed the check in 24 hours to hold the apartment for her. Suddenly, her high-tech, futuristic bank was operating on the timeline of the Pony Express. Panic set in. She called customer service. After navigating a phone tree and waiting on hold for 20 minutes, she finally spoke to a representative. He was polite but powerless. The policy was the policy. There was no branch to visit, no manager to plead her case to, no physical person who could override the system and print a check for her. She was talking to a disembodied voice 1,000 miles away, constrained by a rigid, unchangeable process. Her financial life was trapped behind a digital wall, and she couldn't find the door. She ended up having to transfer a large sum of money back to her old, low-interest brick-and-mortar account, wait for it to clear, and then rush to a branch to get the check she needed. She barely secured the apartment, but the entire ordeal left her shaken. The interest she had earned over the past few months felt trivial compared to the stress and the near miss of losing her new home. The final straw, however, wasn't about logistics. It was about fear. One evening, Jessica got a fraud alert. A suspicious online purchase for over $900 had been attempted from a different state. Her online bank, to its credit, had a great security system and automatically declined the charge and froze her debit card. So far so good. She requested a new card through the app and was told it would arrive in 7 to 10 business days. But the next day, her account was completely frozen. She couldn't log in. She couldn't transfer money. Her direct deposit was scheduled to hit the next day. She had bills to pay. This time, her call to customer service was filled with genuine dread. She was bounced between 3 different departments. The first person couldn't verify her identity to their satisfaction over the phone. The second person, from the fraud department, was reading from a script and couldn't provide any specific details about why the entire account was locked, not just the card. The third person promised a specialist would call her back within 24 hours. No one called. This is the moment the true cost of not having a branch becomes terrifyingly clear. When your access to your own money is severed, you don't want an email or a chatbot. You want to walk into a building, sit down across from a human being, show them your driver's license and say, "Help me. This is my money. I need it." That human connection, that ability to have someone look you in the eye and take ownership of your problem, is a form of insurance. It's a service that doesn't show up on a fee schedule or an APY comparison chart, but its value is immense. Jessica eventually got her account unlocked after 2 agonizing days of constant calls. It was a simple misunderstanding in the security system, a flag that was never properly cleared. But the damage was done. She no longer felt clever for choosing a high-yield online bank. She felt vulnerable. She had traded the assurance of a physical presence for a few extra dollars a month. She had optimized for the best-case scenario, earning interest while her money sat safely, but was completely unprepared for the worst-case scenario. Her story isn't an outlier. It's a perfect illustration of the fundamental trade-off. Online-only banks excel at the 99% of routine digital transactions. They are fantastic for automated savings, simple payments, and a clean user interface. But for that critical 1%, the edge cases, the complex situations, the emergencies, the lack of physical infrastructure can transform a simple problem into a full-blown crisis. It forces you to ask a very personal question. How much is your peace of mind worth? And is the convenience of digital-first banking worth the risk when things inevitably go wrong? The answer to that question is complex, because the technology that creates these problems is also the source of some of the industry's most powerful and innovative solutions. Let's start by unpacking that idea of innovative solutions, because this is where the entire argument for online-only banking truly begins. For every potential pitfall of a digital system, there's an equally, if not more powerful upside. The first and most attention-grabbing advantage is something that impacts your bottom line directly: the interest rates. Specifically, the rates offered on high-yield savings accounts, or HYSAs. For decades, the savings accounts at big, traditional brick-and-mortar banks have been something of a joke. You might see an annual percentage yield, or APY, of 0.01%. Let's put that into perspective. If you put $10,000 into that account and left it there for an entire year, you would earn a grand total of $1. One single dollar for letting a multi-billion-dollar institution use your money. It's less of a return and more of a rounding error. Now, compare that to a typical online-only bank. As of late, it's not uncommon to see HYSAs from these digital banks offering APYs of 4%, 4.5%, or even over 5%. Let's run the numbers on that same $10,000. At a 4.5% APY, after 1 year, you wouldn't have $1. You'd have an extra $450. That's not a rounding error. That's a plane ticket, a new phone, or a significant dent in a credit card bill. The difference is staggering. And the natural question is, how is this possible? Is it a scam? Is there some hidden catch? The reality is far more simple and, frankly, a bit boring. Comes down to one word: overhead. A traditional bank has to pay for thousands of physical branches. That means rent or mortgages on prime real estate, electricity bills, security systems, landscaping, property taxes, and of course the salaries for all the tellers, managers, and loan officers who staff those locations. It is an incredibly expensive business model. And all of that cost has to be paid for somehow. It's paid for by offering you, the customer, minuscule returns on your savings. Online-only banks, on the other hand, have virtually none of that overhead. Their headquarters might be a single office building in one city. Their branches are their websites and their mobile apps. They don't need thousands of tellers because you are your own teller, depositing checks with your phone's camera. By slashing these immense physical costs, they can afford to pass a huge chunk of those savings back to their customers in the form of higher interest rates. It's not a magic trick. It's just a fundamentally more efficient business model for the digital age. They are competing for your money not with fancy lobbies and free lollipops, but with cold hard cash in the form of better returns. This low overhead advantage bleeds directly into the second major pro, the dramatic reduction and often complete elimination of fees. Think about the common fees that have plagued bank customers for years. The monthly maintenance fee, a $10 or $15 charge just for the privilege of having an account. The overdraft fee, where a small miscalculation can cost you a punitive $35. ATM fees for using a machine that's not in your bank's specific network. Foreign transaction fees. The list goes on. Each one is a tiny paper cut, but together, they can lead to a significant financial drain over time. Online banks saw this as a massive point of frustration, and another area where their business model gave them a competitive edge. Since they don't have the same costs, they don't need to nickel and dime their customers to stay profitable. As a result, you'll find that the vast majority of reputable online banks offer checking and savings accounts with no monthly maintenance fees and no minimum balance requirements. This alone can save you over $100 a year. But they didn't stop there. They tackled the overdraft fee, one of the most hated charges in all of consumer finance. Many online banks have simply eliminated it. If you don't have the money in your account, the transaction is simply declined. No harm, no foul. No $35 penalty for buying a $5 coffee. Others have introduced small, fee-free overdraft protections, allowing you to go negative by a small amount without penalty. Then there's the ATM problem. If an online bank has no physical branches, how do you get cash? This was a major hurdle in the early days. The solution was brilliant. Instead of building their own expensive ATM network, many online banks simply offer to reimburse the fees you get charged for using any other bank's ATM. Some will reimburse up to a certain amount per month, while others offer unlimited reimbursements. Suddenly, every single ATM in the country, whether it's in a Chase Bank, a 7-Eleven, or a local credit union, becomes your free ATM. This single policy transformed a massive disadvantage, no physical presence, into a huge advantage, unparalleled convenience. The third, and arguably most important advantage, is the technology itself. For a traditional bank, the mobile app and the website are often extensions of the real bank, the branch. They can be clunky, slow, and limited in functionality. For an online-only bank, the app is the bank. It is the entire business. As a result, they pour immense resources into making their user experience as seamless, intuitive, and powerful as possible. This manifests in several ways. First, the core functionality is just better. Transferring money, paying bills, and depositing checks is typically faster and requires fewer clicks. The user interface is cleaner and designed for a mobile-first world. But it's the features built on top of that core experience where they truly shine. Many online bank apps come with sophisticated, built-in budgeting tools that automatically categorize your spending, helping you see exactly where your money is going without needing a separate app. They often feature savings tools that allow you to create specific goals or buckets. You can set up a vacation bucket, a new car bucket, and an emergency fund bucket, and then automate transfers into each one. This simple psychological trick of partitioning your money makes saving for specific goals feel more tangible and achievable. And then there's one of the most popular features: early direct deposit. Because of the way the traditional banking payment system works, it can take a couple of days for a payroll deposit to clear. Online banks, with their more modern, streamlined technology stacks, can often see these incoming transfers and make the funds available to you as soon as they receive the notification from your employer. This means you can get your paycheck up to 2 days earlier than you would at a traditional bank. For millions of people living paycheck to paycheck, getting access to their money on a Wednesday instead of a Friday is not a small perk. It can be a financial lifeline, helping them avoid late fees or the need for a high-interest payday loan. So when you put it all together, the high-yield savings accounts that actually grow your money, the near-total elimination of predatory fees, and a suite of powerful, convenient technological tools, the case for online-only banking becomes incredibly compelling. It presents a vision of banking that is more efficient, more transparent, and more aligned with the customer's financial well-being. But with all this convenience and all these financial perks, what are we giving up in return? Is the user experience so good that we're overlooking hidden risks in the fine print? The truth about what powers these digital-first banks, and who really holds the cards, is more complex than you might think. To understand this, we need to pull back the curtain on a secret that the digital banking world isn't exactly shouting from the rooftops. Many of the most popular online banks you see advertised aren't actually banks at all. That might sound shocking, but it's the fundamental truth of the fintech revolution. What you're often interacting with is a technology company, a neobank, that has built an incredible user-friendly app and a strong brand. They are masters of design, user experience, and marketing. They figured out how to make managing your money feel modern, seamless, and even enjoyable. But getting an actual banking charter in the United States is an incredibly difficult, expensive, and time-consuming process. It involves navigating a labyrinth of federal and state regulations, meeting strict capital requirements, and undergoing intense scrutiny from bodies like the FDIC and the Office of the Comptroller of the Currency. It's a moat designed to ensure stability in the financial system. So, how do these tech companies offer bank accounts, debit cards, and other financial services without being banks themselves? They use a model often called Banking as a Service, or BaaS. Think of it like this. Imagine a brilliant, innovative chef who makes the best tacos in the world. This chef has a cool, modern food truck, a catchy name, and a huge following on social media. People line up for blocks to get their food. But to operate legally, that food truck needs to be associated with a licensed, health-inspected commercial kitchen. The chef doesn't want the headache and expense of building their own massive kitchen, so they partner with an established one. They use the kitchen's facilities, its permits, and its infrastructure to prepare their food, which they then sell from their own branded truck. In this analogy, the fintech company is the taco truck. They have the brand, the app, and the direct relationship with you, the customer. The actual, chartered, FDIC-insured bank is the commercial kitchen. It's the regulated institution working in the background, providing the essential infrastructure. The fintech company essentially rents the bank's charter and regulatory compliance. Your money isn't actually held by the cool app on your phone. It's held in an account at their partner bank. When you swipe your stylish neobank debit card, the transaction is being processed through the partner bank's network. This partnership is the engine that has allowed for such explosive innovation in finance. It lets the tech companies do what they do best: build amazing technology and focus on the customer experience. They aren't bogged down by decades-old legacy software or the bureaucratic inertia that can sometimes plague traditional institutions. This is why their apps are often faster, cleaner, and more intuitive. They can roll out new features like early direct deposit, automated savings tools, and detailed spending breakdowns much more quickly. For the consumer, this means more choice, better technology, and often lower fees, because the fintech's overhead is significantly less than a brick-and-mortar bank with thousands of branches and employees. But this model, for all its benefits, introduces layers of complexity and potential points of friction that you simply don't have when your bank is, well, your bank. The first and most common issue is customer service. Imagine a scenario. Your paycheck is supposed to be direct deposited on Friday, but it's Monday and the money is still not in your account. You're starting to panic. Bills are due. So you open the sleek chat function in your fintech app. You explain the situation to a customer service representative. They're polite, but after some checking, they tell you, "We don't see the deposit on our end. You'll need to check with the partner bank." Now you're confused. You don't even know the name of the partner bank, let alone how to contact them. After digging through the app's terms and conditions, you find a name, let's say it's Midwest Community Bank, and a phone number. You call them. After navigating a phone tree and waiting on hold, you finally speak to a representative at this bank you've never heard of. You explain the situation again. Their response? We're sorry, but we don't provide direct customer support for the Fintech's accounts. We only provide the back-end infrastructure. You need to resolve this through their app. You've just been caught in the customer service gap. The taco truck is blaming the commercial kitchen, and the commercial kitchen is telling you to talk to the taco truck. Meanwhile, you're just hungry for your money, and neither side seems able to give you a straight answer. This is a very real frustration for some users. When things are running smoothly, the experience is fantastic. But when something goes wrong, figuring out who is truly responsible for fixing it can become a nightmare. Beyond customer service, there's the critical question of security and insurance. Your money should be protected by FDIC insurance, which covers up to $250,000 per depositor, per insured bank, in the event the bank fails. With this partner bank model, your money is held at the FDIC-insured partner bank, so it should be covered. However, the responsibility is on you, the consumer, to verify this. A reputable fintech will be very clear about its banking partnerships. Somewhere on their website or in their app, often in the footer or in the legal disclosures, it should explicitly state, banking services provided by partner bank name, member FDIC. If you cannot easily find this information, that is a massive red flag. You need to know which commercial kitchen is holding your money. Because if the fintech company, the taco truck, goes out of business, your money is not lost. It's still safe and sound at the underlying partner bank. But if you don't know who that bank is, reclaiming your funds can become a complicated process. The risk here, though rare, is a breakdown between the fintech and its partner bank. In 2023, we saw a glimpse of what this can look like when a key middleman company that connects fintechs to partner banks had its assets frozen by regulators. For a few days, customers of several fintech services found their accounts frozen and their debit cards not working. The issue was resolved, but it was a stark reminder that when you add more links to a chain, you add more potential points of failure. The system works until it doesn't. This isn't to say the model is inherently bad. In fact, it's what has forced the entire banking industry to innovate and offer better products. But it does mean that as a consumer, you're taking on a slightly different kind of risk profile. You're trading the simplicity of a single, vertically integrated institution for the features and user experience of a multi-layered partnership. You're betting that the seamless front-end experience is worth the potential for back-end complexity if something goes wrong. So the key takeaway is due diligence. Before you sign up for one of these services, you need to become a financial detective. Find out who their partner bank is. Confirm that the partner bank is a legitimate, FDIC member institution. You can look this up directly on the FDIC's own website using their Bank Find tool. Read reviews not just about the slick features, but specifically about users' experiences with customer service when they had a problem. Understanding this structure is the most critical step in evaluating an online-only bank. It's the difference between being a savvy consumer who knows exactly how their money is being handled and being a user who is blindsided when something inevitably goes wrong. Now that we've lifted the hood and examined the complex engine of partner banks that powers this industry, let's talk about the shiny features this engine produces. Are the high-yield savings accounts, the fee-free checking, and the promise of getting your paycheck 2 days early really as good as they sound? Or is there a catch hidden in the fine print of the interest rates and transaction limits? That's where we're going next. Let's start by dissecting that high-yield savings account. On the surface, it's the most compelling reason to switch. You look at your traditional bank, the one with the marble columns and the free lollipops, and you see a savings account interest rate of maybe 0.01%. You put $10,000 in there, and after an entire year you've earned $1. Enough to buy a gumball. Maybe. Then you see an online bank offering 4.5% APY. You do the math on that same $10,000, and at the end of the year you've earned $450. That's not a gumball. That's a weekend trip. That's a significant dent in a car repair. The difference is staggering, and it's not a scam. Online banks can offer this because their business model is fundamentally leaner. They aren't paying for thousands of physical branches, the electricity to keep the lights on, the landscaping out front, or the salaries of tellers in every neighborhood. They pass a portion of those operational savings directly to you in the form of a higher interest rate. It's a simple, powerful value proposition. But here's the first piece of fine print you need to understand. That incredible rate is almost always variable. It's not a fixed contract. The annual percentage yield, or APY, can and will change. These rates are heavily influenced by the federal funds rate, which is set by the Federal Reserve. When the economy is in a phase where the Fed is raising rates to combat inflation, the rates on these high-yield savings accounts soar. feels like free money. However, when the Fed decides to cut rates to stimulate the economy, you will see the APY on your online savings account start to drop, sometimes month after month. The bank will send you an email notification, and suddenly that 4.5% becomes 4.25, then 4.0, and so on. It's still likely to be leagues better than a traditional bank, but the massive earnings you calculated for the next 5 years might not materialize in the same way. You have to be prepared for that fluctuation. Some banks might also use a teaser rate, an extra high APY for the first 3 or 6 months to get you in the door, before it drops to their standard variable rate. Or they might employ a tiered system, where you only get the advertised top rate on balances up to, say, $5,000 or $10,000, with a much lower rate on any amount above that. The catch isn't that it's a bad deal. The catch is that it's a dynamic one that you need to pay attention to. Now let's talk about that fee-free checking. This is another massive draw. The average monthly maintenance fee at a big traditional bank can be anywhere from $12 to $15 unless you meet certain requirements, like maintaining a minimum daily balance of $1,500 or setting up a qualifying direct deposit. If you don't meet those rules, you're paying up to $180 a year just for the privilege of letting the bank hold your money. Online banks sweep this away. No monthly fees, no minimum balance requirements. That $180 stays in your pocket. This is a clear, unambiguous win, especially for people who are just starting out, students, or anyone whose income or account balance fluctuates. But fee-free doesn't mean zero fees ever. The most common gotcha is with ATMs. Most online banks are part of a large fee-free ATM network like Allpoint or MoneyPass. As long as you use an ATM within that network, you're golden. The problem is when you're in a hurry, or in a rural area, and the only ATM available is a standalone machine in a convenience store or one owned by a rival bank. In that case, the online bank won't charge you a fee, but the owner of that ATM certainly will, often to the tune of $3 or $4. Some premium online accounts will reimburse these third-party ATM fees, but many don't, or they'll cap the reimbursement at something like $10 a month. So you have to be more strategic about getting cash. Another area is overdrafts. The marketing says no overdraft fees, which sounds incredible, but it's crucial to understand what that means in practice. For many online banks, it doesn't mean they'll cover your purchase and let you sort it out later. It means your transaction will simply be declined. So while you avoid a $35 fee, you might also face the awkwardness of your card being rejected at the grocery store checkout. Some banks offer an optional overdraft protection service, but this is often a line of credit you have to apply for. And if you use it, you're paying interest. The fee is gone, but it's been replaced by a different system you have to navigate. Finally, let's look at the promise of getting paid up to 2 days early. This feature feels like magic, but the mechanics are quite simple. When your employer runs payroll, they send the payment information through the automated clearinghouse or ACH network. This notification usually arrives at the banks a day or two before your official payday. Traditional banks see this pending deposit, but they hold on to the funds until the settlement date, your actual payday. Online banks, in a clever marketing and customer service move, have decided to make those funds available to you the moment they receive the ACH notification. It's a cash flow tool. For someone managing their budget very tightly, getting paid on a Wednesday instead of a Friday can mean the difference between paying a bill on time or getting hit with a late fee. It can be a genuine lifeline. The catch here is subtle but significant. First, the up to 2 days is not a bank guarantee. It's entirely dependent on your employer's payroll processor. If your company submits payroll late, or just 1 day in advance, that's when you'll get your money. The bank has no control over it. Second, and more psychologically important, is that it shifts your baseline. You get used to being paid on Wednesdays. Your brain rewires itself to see Wednesday as payday. The 2-day buffer you used to have between your money running out and your next paycheck is now gone. You're still living on the same cycle, just shifted 2 days earlier. Now, if there's a bank holiday or a glitch in your company's payroll that delays the deposit until the official Friday payday, it feels catastrophic. Feels 2 days late even though it's technically on time. This can cause the exact financial stress the feature was designed to alleviate. It's not giving you more money, it's just changing your relationship with time, and that can have unintended consequences if you're not careful. These features are powerful, and for millions of people they represent a better, more efficient way to bank. But they aren't without their own unique set of rules and behaviors you have to learn. They demand a more hands-on, digitally aware consumer. The convenience is immense, but it comes with the responsibility of understanding the new system you're operating in. But what happens when that system breaks? What happens when there's a fraudulent charge on your account, or your debit card gets skimmed, and there's no building you can walk into, no manager you can demand to see? How do you solve a real problem when the only tool you have is a chatbot or a call center? This is the single biggest fear people have about going digital only, and it's not an irrational one. It's the Achilles heel of the entire online banking model, because when everything works, it's magic. But when it breaks, you find yourself screaming into a digital void, and there's nobody there to scream back. Let's break down what actually happens. Your first line of defense, or rather the bank's first line of defense against you, is the chatbot. It's an automated system designed with one primary goal: to prevent you from talking to an expensive human being. You type in, "I have a fraudulent charge for $500 from a store I've never heard of." The bot, with the cheerful ignorance only a machine can possess, replies, "I can help with that. Here's an article on how to set up overdraft protection." You try again using simpler words. "Fraud on my account." The bot might then ask you to choose from a list of options, none of which match your urgent, specific problem. It's a labyrinth of pre-programmed responses, and you're the rat in the maze. After 10 minutes of digital purgatory, you finally type the magic words, "Speak to a representative," and you're put into a queue. This is where the second circle of hell begins, the call center. You'll hear the hold music, that repetitive, soulless jingle that will be seared into your brain for eternity. And when you finally get a human, where are they? Are they in a dedicated corporate office in Ohio? Or are they in a third-party call center halfway around the world, reading from a script, with only a surface-level understanding of US banking regulations? You pour your heart out, explaining the panic you feel. The representative is polite but powerless. They say, "I see the charge, sir, but that's handled by our fraud department. Let me transfer you." The hold music returns. A new person picks up. You have to start your story all over again from the very beginning, because your information wasn't passed along. This new person listens, puts you on hold to look into it, and then the line mysteriously disconnects. You have to call back and start the entire process over. Now, compare this to the old-fashioned way. You walk into a physical branch of a traditional bank. You might have to wait in line, sure, but you can walk up to a teller, look a human being in the eye and say, "There is a fraudulent charge on my account." They can pull up your profile, see your history, and see that you're a real person standing in front of them. More often than not, they can provisionally credit the money back into your account right then and there while the investigation happens. If the teller can't solve it, you can ask for the branch manager. There is a clear physical chain of command. You can escalate. With an online bank, your only escalation is to hang up and hope you get a more competent representative on the next call. You have zero leverage. Let's talk about a real-world case study. Imagine a woman will call Sarah. She's on a dream vacation in another state, and she uses her debit card from a popular online bank at a gas station. A few hours later, her phone buzzes with alerts. $100 at a liquor store, $200 at a big box retailer, $300 in cash from an ATM. Her card has been skimmed and cloned. Panicked, she opens the app and freezes her card. So far so good. But now she has no access to her money, hundreds of miles from home. She calls the bank. After an hour on hold, she gets through. They confirm the fraud and tell her they'll mail a new card to her home address. "But I'm not at home," she pleads. "I'm on vacation. I need money now." The representative's answer is chilling. "I'm sorry, ma'am, our policy is to mail it to the address on file. It should arrive in 7 to 10 business days." She was stranded. Her only solution was to have a family member wire her money via Western Union. The fraud charges were eventually reversed, but the experience was a nightmare. Had she been with a bank with a physical footprint, she could have walked into a local branch, verified her identity, and likely walked out with a temporary card and emergency cash that same day. The lack of in-person service isn't just an inconvenience. It can be a crisis. It's the difference between a problem and a catastrophe. And it's not just about fraud. What if the bank's own security algorithm misfires? This is another common horror story. Let's say you save up and decide to buy a used car with cash from a private seller. You make an unusually large withdrawal or transfer. The bank's algorithm, designed to spot strange behavior, flags your account. It doesn't just block the transaction. It freezes your entire account. All your money, your direct deposit, your automatic bill payments, everything. Now you have to prove to a faceless entity over the phone that you are who you say you are, and that you were, in fact, trying to use your own money. They'll ask you to upload a picture of your driver's license, a utility bill, maybe even a selfie of you holding your ID. You send the documents into a digital abyss and wait. And wait. Days go by. Your rent is due. Your car payment is about to bounce. You call again and again, and each time you get a different person who gives you a slightly different answer. We've received your documents and they're under review. The review process takes 3 to 5 business days. It seems we haven't received the documents. Could you upload them again? You are completely at the mercy of an invisible bureaucratic process with no one to hold accountable. This powerlessness is the true cost of not having a branch. But the problems with a physical-less world don't stop with emergencies. They extend to one of the most basic functions of a bank: handling cash. We think of our society as increasingly cashless, but physical money is still a huge part of many people's lives. If you're a waiter, a bartender, a barber, or anyone who gets paid in tips, what do you do with that wad of bills at the end of your shift? With a traditional bank, you go to the ATM or the night depository. Simple. With an online-only bank, you have a serious logistical problem. Some online banks are part of ATM networks that allow cash deposits, but these can be hard to find and often have strict limits on how much you can deposit. So what are the workarounds? They're almost comical in their absurdity. You could go to a convenience store, buy a money order with your cash, and then use your banking app to take a picture of the money order to deposit it. This process costs you money and fees and takes several days for the funds to clear. The other common and frankly terrible piece of advice is to give your cash to a trusted friend or family member, have them deposit it into their traditional bank account, and then have them transfer the money to you through an app like Zelle or Venmo. You are literally laundering your own money through someone else's account. It's insecure, it's unprofessional, and it puts your relationships in a very awkward position. And it goes the other way too. What if you need to get a large amount of cash? Forget a mortgage down payment. Let's talk about something smaller. You find a perfect used motorcycle on Craigslist for $2,000, and the seller only takes cash. You can't just go to your online bank and get it. You're bound by the daily ATM withdrawal limit, which might be $500. So you spend 4 consecutive days going to an ATM, pulling out the maximum each time, just to assemble the cash you need. It turns a simple transaction into a multi-day ordeal. So you're wrestling with chatbots and mailing money orders just to manage your own money. Feels archaic. But the whole promise of these banks is their cutting-edge technology. Their apps are sleek, their features are futuristic. But what happens when that same technology, the very thing designed to protect you, turns against you? What happens when the algorithm decides you're a risk and with a single digital keystroke you're not just locked out? You're kicked out entirely with your financial life in ruins. It starts with a simple, mundane moment. You're at the grocery store, a full cart, a long line behind you. You tap your debit card. Declined. You try again. Declined. A flush of embarrassment. You pull up your banking app, expecting to see a low balance, but what you see instead sends a jolt of ice through your veins. A single sterile message. Account access restricted. This isn't a hypothetical scenario. This is the digital nightmare that thousands of Americans have woken up to. One moment you have a fully functioning financial life. The next, you're a digital ghost locked out of your own money with no warning and, most terrifyingly, no clear explanation. The culprit is almost never a person. It's the algorithm, the silent, all-seeing guardian of the bank's digital fortress. These complex systems are designed to detect patterns that deviate from your norm, sniffing out potential fraud, money laundering, or other illicit activities with ruthless efficiency. And for the most part, they do an incredible job protecting both you and the bank. But they are not infallible. They operate on data points and probabilities, not context or intent. So what triggers the alarm? Could be something you'd never think twice about. Did you just receive a large Zelle payment from selling a couch on Facebook Marketplace? That's an unusually large, non-payroll deposit from an unknown source. Flag. Did you use a VPN for privacy and accidentally log into your account from an IP address that appears to be in another country? That looks like a potential account takeover. Flag. Did you start making frequent small deposits into a crypto exchange? To an algorithm that can mimic a pattern called structuring, used to avoid federal reporting requirements. Flag. Even your associations can condemn you. If someone who has been flagged for fraud sends you money, or if you send money to them, the algorithm can decide you're part of a suspicious network. You become guilty by digital association. The system doesn't know you were just paying your friend back for pizza. It just sees a connection to a high-risk entity and slams the gate shut. In that moment of panic at the grocery store, your first instinct is to call customer service. This is where the chasm between a traditional bank and an online-only bank becomes a terrifyingly deep canyon. At a brick-and-mortar bank, in a worst-case scenario, you can walk into a branch. You can present your driver's license, your passport, your birth certificate. You can look a human being in the eye and say, "This is me. This is my money. What is going on?" It might not solve the problem instantly, but there's a physical path to recourse. There's a person. With an online bank, you enter the labyrinth. You'll first be greeted by a chatbot, which can't handle your issue. Then you wait on hold, sometimes for hours, to speak to a frontline customer service representative. This person is likely following a rigid script and has no real power. They can see your account is frozen, but they can't see why. They'll tell you it's been escalated to the back-office security team or the fraud prevention department. And here's the most maddening part. You can't speak to that department. They don't have a phone number. They don't have a direct email. They are an invisible, unreachable tribunal that holds your entire financial life in their hands. You're told to wait for an email that may come in 24 hours or 72 hours or, in some documented cases, never at all. Days turn into weeks. Your rent is due. Your car payment is about to auto-draft from an account with a $0 balance. Your credit score is taking a nosedive with every missed payment. You send desperate emails into the void, and the replies you get back are canned, impersonal, and infuriatingly vague. "We are still reviewing your account for security purposes. We appreciate your patience." But patience doesn't pay the electric bill. Why the secrecy? Why can't they just tell you what the problem is so you can fix it? The answer lies in federal law. Regulations like the Bank Secrecy Act and the Patriot Act put immense pressure on financial institutions to police their own customers. If a bank is found to be facilitating money laundering, even accidentally, the fines can be catastrophic, reaching into the billions of dollars. Because of this, they operate under a principle of extreme caution. Furthermore, if they suspect certain types of illicit activity, they are legally prohibited from telling you about it. It's a practice known as tipping off, and it's a federal crime. Informing a potential criminal that they're under investigation could compromise a larger law enforcement operation. So the bank's algorithm flags you, a human reviewer might agree, and they file a suspicious activity report or SAR with the Financial Crimes Enforcement Network. And from that moment on, they are legally forbidden from discussing the details with you. You, the innocent person who just sold a used car, are treated with the same silent procedure as a cartel money launderer. You are collateral damage in the war on financial crime. So what happens to your money? If the bank decides the risk is too great, they won't just freeze your account. They will terminate their relationship with you entirely. This is the banking equivalent of a death sentence. They will close all your accounts, checking, savings, everything. By law, they have to return your money. But they don't just wire it to another bank. They typically mail a paper check to the last address they have on file. This process can take weeks, sometimes even months. Imagine your entire life savings, your emergency fund, your operating capital for your small business, is now a piece of paper floating somewhere in the United States Postal Service system, while your financial obligations stack up, day after agonizing day. This isn't just an inconvenience. It's a potential life-ruining event. And it is, without a doubt, the single greatest risk of going all in with an online-only bank. The very efficiency and automation that make them so appealing are the same things that can make this experience so brutally impersonal and destructive. So how do you protect yourself from this digital guillotine? The most important strategy is diversification. Do not, under any circumstances, keep all of your money in a single online bank, no matter how great the interest rate is. Maintain a relationship with a second financial institution, preferably a local credit union or a national bank with a physical presence in your town. Keep enough money in that backup account to cover at least 1 to 2 months of essential living expenses. This is your lifeline. If your online account is ever frozen, you can still pay your rent, buy groceries, and keep the lights on while you fight to get your money back. Second, be mindful of your transaction behavior. If you are anticipating an unusual transaction, like a large wire transfer from selling a property or an inheritance, it may be prudent to use your traditional bank account for that specific event. Their systems are often more accustomed to these larger one-off transactions, and you have a person to talk to if a flag is raised. And finally, document everything. Keep records of large sales. If you're using peer-to-peer payment apps, use clear and descriptive memos. Don't write joke memos like, "for the secret stuff." Sounds silly, but these things are scanned by algorithms, and you don't want to give them any reason to look twice. The risk of an account freeze or closure exists at every bank, traditional or online. But the powerlessness, the isolation, the sheer terror of being locked out by an invisible algorithm with no human recourse, that is a uniquely modern fear. And it's a con of online banking that you have to weigh very, very carefully. You're trading the safety net of human interaction for a higher interest rate and a slicker app. But this internal threat, this risk from the bank's own systems turning against you, is only one side of the security coin. What about the external threats? What about the hackers and scammers trying to get in? In a world with no physical vaults, how safe is your money from the dangers lurking outside the digital walls? This brings us to the heart of the fear for many people. It's the digital boogeyman, the invisible threat. When your money isn't in a vault but exists as ones and zeros on a server somewhere, it feels vulnerable. It feels like a skilled hacker could just type a few lines of code and poof, it's all gone. But the reality of digital bank security is far more complex, and frankly, far more robust than most people imagine. Let's start with the first line of defense: encryption. You hear this word thrown around all the time, but what does it actually mean for your money? Imagine you write a secret message to your bank. Before you send it, you run it through a special machine that scrambles it into a completely unreadable jumble of letters and numbers. The only way to unscramble it is with a unique secret key that only you and your bank possess. That, in essence, is encryption. Online banks use military-grade encryption, typically AES 256-bit. To put that into perspective, the world's most powerful supercomputers would need to work for literally billions of years to crack a single 256-bit key by brute force. Every piece of data, from your login password to your transaction history, is wrapped in this unbreakable digital code whenever it travels between your device and the bank's servers. It's not just a locked door. It's a message that's been turned into gibberish that only the intended recipient can ever understand. But a strong lock isn't enough if someone steals your key. This is where the second layer comes in: multi-factor authentication, or MFA. You've definitely used this even if you don't know the name. It's the banking world's version of Prove It. It works on the principle that to access your account, you need to provide more than just one piece of evidence that you are who you say you are. It's typically a combination of something you know, like your password, something you have, like your phone receiving a one-time code, and sometimes something you are, like your fingerprint or your face. So even if a cybercriminal manages to steal your password, maybe from a data breach at a completely different company where you foolishly reused it, they still can't get in. They hit a second wall. They'd also need to have your physical phone in their hand to approve the login. This single feature, which is standard practice at virtually every reputable online bank, neutralizes one of the biggest threats to personal account security: stolen passwords. Then there's the third layer, the silent guardian that's always watching: advanced fraud monitoring. This is where online banks, being native technology companies, truly shine. They employ sophisticated artificial intelligence and machine learning algorithms that are constantly analyzing patterns in your spending. These systems learn your behavior. They know you usually buy coffee at 8 a.m. in Chicago. They know you pay your rent on the first of the month. They know you've never bought $5,000 worth of electronics from a warehouse in another country. So when a transaction suddenly appears that breaks your pattern, red flags go up instantly. The system might automatically block the transaction and send you a text message or a push notification asking, "Hey, was this you?" This isn't some guy in a back office checking a spreadsheet. It's a powerful self-learning AI that acts as a 24/7 security detail for your account, capable of spotting anomalies in milliseconds that a human would almost certainly miss. And finally, there's the ultimate safety net, the one that protects you not from hackers, but from the bank itself failing. Just like their brick-and-mortar counterparts, legitimate online-only banks in the United States are FDIC insured. The Federal Deposit Insurance Corporation is an independent agency of the U.S. government that protects you against the loss of your insured deposits if an FDIC-insured bank or savings association fails. This means your money, up to $250,000 per depositor, per ownership category, is backed by the full faith and credit of the United States government. So, if your online bank were to go out of business tomorrow, your money wouldn't just vanish into the digital ether. The FDIC would step in and make you whole. This is a critical point. From an institutional collapse perspective, your money is just as safe in an FDIC-insured online bank as it is at the megabank down the street. So the digital fortress is strong. The walls are high, the locks are complex, and there are guards on patrol 24/7. But here's the uncomfortable truth. The greatest vulnerability in this entire system isn't the technology. It's us, the human element. The most common way people lose money isn't from a super hacker breaching the bank servers in a dramatic movie scene. It happens in a much quieter, more deceptive way. It happens through phishing. You get an email that looks exactly like it's from your bank. The logo is perfect, the language is urgent. Suspicious activity detected on your account. Please click here to verify your identity immediately. Or a text message. Your account has been locked. Follow this link to restore access. You're worried. You click the link. It takes you to a web page that is a pixel-perfect replica of your bank's login page. You enter your username and password. And that's it. Game over. You didn't get hacked. You were tricked into handing over the keys to the front door. The scammers now have your credentials and they can try to bypass the multi-factor authentication, perhaps by calling you, pretending to be the bank's fraud department, and tricking you into reading them the security code that just got sent to your phone. Yes, sir, to verify your identity, please read me the 6-digit code you just received. And just like that, you've not only given them the key, you've held the door open for them. This is why personal vigilance is non-negotiable in the age of digital banking. It's about cultivating a healthy sense of skepticism. Banks will almost never text or email you a link to log into your account. They will never call you and ask for your password or a one-time security code. If you get a message that seems even slightly off, your first move should never be to click. It should be to close the message, open a fresh browser window, manually type in your bank's official web address, and log in there directly. Or, even better, call the official customer service number on the back of your debit card. The debate over whether online banks are safer than traditional banks often misses the point. It's not about one being safer than the other. It's about recognizing they face different types of threats. A traditional bank has to worry about someone robbing a branch at gunpoint or installing a card skimmer on an ATM. An online bank has to worry about denial of service attacks and sophisticated phishing campaigns. But in many ways, the digital-first nature of online banks forces them to be hyper-focused on cybersecurity. It is their entire world. Their reputation, their very existence, depends on their ability to keep your data and money secure. They often adopt new security technologies faster than the larger, more bureaucratic traditional institutions. Ultimately, security is a partnership. The bank builds the fortress, but you control the main gate. You can have the most advanced security in the world, but it means very little if you write your password on a sticky note or give your login details to a scammer over the phone. So the digital walls are strong and you hold the keys. The technology is arguably as safe, if not in some cases safer, than a traditional bank. But what happens when something does go wrong? Not a hack, but a simple human problem. A lost card. A disputed charge. A question you can't find the answer to in an FAQ. With no branch to walk into and no teller to talk to face-to-face, who do you turn to? How does customer service in a digital-only world really stack up when you need a human touch the most? This is the Achilles heel. The one area where the digital utopia of online banking can crumble into a frustrating, isolating nightmare. When things go wrong, and in banking as in life, things will eventually go wrong, the quality of customer service becomes the single most important feature of your bank. It's not about the interest rate anymore. It's not about the slick app design. It's about getting a competent, empathetic human being on the line who can actually solve your problem. The front line of customer support in an online-only bank is by design digital. First, you'll encounter the chatbot. We've all been there. Stuck in a maddening loop with an algorithm that's been programmed to answer the 50 most common questions. If you need your routing number or want to know the daily transfer limit, a chatbot is fantastic. It's instant. But the moment your problem has any nuance, the moment it falls outside the neat little boxes of its programming, that chatbot becomes a digital brick wall. You find yourself typing "speak to a human" or "live agent" over and over, your frustration mounting with each canned response. If you get past the bot, you'll likely be funneled to a live chat. This can be a significant step up. You're talking to a real person, you can multitask while you wait for a response, and you often get a transcript of the conversation emailed to you, which is fantastic for record keeping. But it's not without its own pitfalls. The agent on the other end might be juggling 3 or 4 other chats simultaneously, leading to delayed responses. The connection can be impersonal, making it harder to convey the urgency or complexity of your situation. Then there's email support. This is the slow, methodical option. It's best for non-urgent matters where you need to lay out a lot of detail or attach documents. But if your card has been frozen and you're standing at a checkout counter, waiting 2 business days for an email response feels like an eternity. Ultimately, for any serious issue, it all comes down to the phone. Picking up your phone and calling a support number is the final escalation, the last bastion of human-to-human problem-solving. And this is where the difference between a great online bank and a terrible one is thrown into stark relief. Some online banks have invested heavily here, offering 24/7, US-based support with knowledgeable agents who are empowered to fix things. Others not so much. They might outsource their call centers, leading to language barriers, dropped calls, and agents who are little more than human-powered FAQs, reading from a script and unable to do anything without escalating your ticket. Let's make this real. Imagine a woman named Chloe. She's a loyal customer of a trendy online bank. She loves the app, she's earning great interest, and she's recommended it to all her friends. She's on a dream vacation in Italy, and she goes to pay for a beautiful leather jacket. Her card is declined. She tries again. Declined. Then she gets a text message. Unusual activity detected. Your account has been temporarily frozen for your protection. Her heart sinks. This is the moment of truth. In the first scenario, Chloe is with a poorly run online bank. She opens the app. The chatbot is useless. She gets into a live chat, and after a 15-minute wait, the agent tells her that to unfreeze her account, they need to text a verification code to her US phone number. But her US SIM card doesn't work in Italy. She explains this. The agent says there's no other way. Her only option is to call the international support number. She gets hit with expensive roaming charges just to wait on hold for 45 minutes, listening to terrible music. Finally, a representative picks up. They're clearly in a noisy call center halfway around the world. They ask her a series of security questions she can't quite remember the answers to. They put her on hold again. They come back and tell her that, for her security, they can't unfreeze the account over the phone. They have to mail a new card to her home address in the United States. It will arrive in 7 to 10 business days. Chloe is stranded thousands of miles from home, with her primary source of funds locked away. The digital convenience has become a digital prison. Now let's rewind. Same situation, but this time, Chloe is with a top-tier online bank that has truly invested in its customer service infrastructure. The fraud alert hits. She opens the app. It immediately gives her a prompt. "Was this you?" with the transaction details. It also gives her a button to tap for an immediate, free call to the fraud department over Wi-Fi. She taps it. Within 2 minutes, she's speaking with a calm, clear US-based agent named Mark. Mark says, "I see the system flagged a purchase in Florence. I can see you're traveling. I just need to verify your identity, and we can get this sorted out." Since the text message verification won't work, he uses an alternative. He asks her about her last few domestic transactions. He asks her to verify the name she put on her account for a specific savings goal. Within 90 seconds, he's verified it's her. He says, "Okay, Chloe, I've lifted the freeze. Your card is active again. I've also placed a travel note on your account for the remainder of your trip, so this doesn't happen again. Is there anything else I can help you with today?" That's the difference. It's not about online versus traditional. It's about a company culture that prioritizes and empowers its support team versus one that treats customer service as a cost to be minimized. The best online banks understand that trust isn't just built with a good interest rate. It's built in those moments of crisis. This is the fundamental trade-off you're making. With a traditional bank, if Chloe had this problem, she could have potentially walked into a branch of that bank's international partner, shown her passport, and solved the problem face-to-face. There's an inherent sense of security in knowing a physical building with your bank's name on it exists. You can look a manager in the eye and say, "I need help." That psychological comfort is real. And it's something online banks have to fight to replicate through technology and stellar service. So how can you, as a potential customer, vet an online bank's customer service before you're in a panic? First, become a detective. Don't just look at glowing reviews on their website. Dig deeper. Go to the Better Business Bureau website, the Consumer Financial Protection Bureau database, Reddit, and Trustpilot. Search for the bank's name plus terms like customer service, frozen account, fraud, or nightmare. Look for patterns. Is everyone complaining about long hold times? Are people consistently praising their fast problem resolution? A single bad review is an anecdote. 100 is a data point. Second, test them yourself. Before you even open an account, call their support line. See how long it takes to get a human on the phone. Ask them a few detailed questions about their fee structure or international wire transfers. Are they helpful and knowledgeable? Or are they just trying to get you off the phone? Try their live chat. See how responsive it is. The quality of their pre-sale support is often a very good indicator of their post-sale support. Third, check the fine print on their support availability. Are they truly 24/7/365? Or are they only open from 9 to 5 on weekdays? Financial emergencies don't keep business hours. You need to know that if your account is compromised at 2 a.m. on a Sunday, someone will be there to pick up the phone. The reality is, for 99% of your interactions with an online bank, you will never need to speak to a human. The apps are designed to be self-service machines. But for that critical 1%, when a transfer goes missing, when you're a victim of fraud, when you're locked out of your own money, the quality of that human interaction is everything. It's the moment that defines your entire banking relationship. So we've broken down the high-yield savings, the slick apps, the ATM fees, and the customer service roulette. We've seen the incredible highs and the potential frustrating lows. The final question remains: who are these banks really for? And more importantly, is an online-only bank the right choice for your specific financial life? We're about to build the ultimate checklist to help you decide once and for all. Let's break it down not as a simple list of pros and cons, but as a series of financial profiles. Find the one that sounds the most like you, and the answer will become crystal clear. First, we have the digital optimizer. This person lives on their smartphone. They use apps to manage everything from their fitness to their finances. The thought of driving to a bank, waiting in line, and filling out a paper slip feels like a relic from a bygone era. For the digital optimizer, the primary goal is efficiency and maximizing returns. They're hunting for the highest possible annual percentage yield, or APY, on their savings. They despise monthly maintenance fees, seeing them as a pointless tax on holding their own money. They want a slick, intuitive mobile app with features like mobile check deposit, easy fund transfers, and detailed spending analytics. For this person, an online-only bank isn't just a good option. It's the only logical choice. The lack of physical branches is a feature, not a bug. It means lower overhead for the bank, which translates directly into those higher interest rates and lower fees they crave. The occasional need for cash is easily solved by a vast fee-free ATM network. For the digital optimizer, the choice is simple. The pros vastly outweigh the cons, which are barely even considered cons in their digitally native world. Next, let's consider the relationship traditionalist. This might be a small business owner, a freelancer who deals with a lot of checks and cash, or simply someone who values face-to-face interaction. For them, banking isn't just a transaction, it's a relationship. They know their local branch manager by name. When they need a complex issue sorted out, like a fraudulent charge or applying for a business loan, they want to sit across a desk from a human being who can look them in the eye. They frequently need services that are difficult, if not impossible, to get from an online-only bank. Cashier's checks on the spot, notary services, a safe deposit box for important documents, or making large cash deposits. For the relationship traditionalist, an online-only bank would be a source of constant friction and anxiety. Imagine their furnace breaks, and the repairman only accepts a cashier's check. With an online bank, they might have to wait days for one to be mailed. With their traditional bank, it's a 10-minute trip down the road. The higher interest rates offered online are tempting, but they don't compensate for the lack of immediate, tangible, human-powered service. For this profile, a brick-and-mortar institution isn't just a preference. It's a necessity for their peace of mind and the smooth operation of their financial life. But here's the thing. Most of us don't fit perfectly into either of these boxes. Most of us are somewhere in the middle. And that brings us to the most powerful and increasingly popular profile, the hybrid strategist. This person is savvy. They understand the strengths and weaknesses of both banking models and have decided to take the best of both worlds. The hybrid strategist keeps a basic checking account with a local, traditional bank or a credit union. This account is their operational hub. It's where they deposit the occasional cash they receive, where they can go to get a document notarized, and their safety net for any in-person banking needs. They might keep just enough in it to waive the monthly fees. But the bulk of their savings, the money they're putting away for a down payment, an emergency fund, or a major future purchase, that money lives in a high-yield savings account at an online-only bank. They've linked their traditional and online accounts, so transferring money between them is seamless, usually taking just 1 or 2 business days. With this setup, they're earning a significantly higher return on their savings than any traditional bank could offer, while completely eliminating the major drawbacks of going fully online. They have access to cash and in-person services when they need them, and they have market-leading interest rates working for them 24/7. This hybrid approach is not a compromise. It's an optimization. It's a recognition that in today's financial landscape, loyalty to a single institution might not serve your best interests. Instead, you can assemble your own, personalized banking system tailored to your exact needs. Finally, there's the focus saver. This individual might not be a tech wizard and may even prefer their traditional bank for day-to-day checking. But they are focused on one specific goal: making their savings grow faster. They've heard about the high interest rates online and they want in, but without disrupting their current setup. For them, opening just a high-yield savings account with an online bank is the perfect, low-friction solution. They can set up an automatic transfer from their traditional checking account every payday and just let the money accumulate, benefiting from the power of compound interest at a much higher rate. They rarely log in, they don't use the app for anything else, but they know their money is working harder for them than it ever could sitting in a legacy savings account earning a fraction of a percent. So to bring it all together, here is the ultimate checklist, framed as a series of questions you must ask yourself. Be honest with your answers. 1. How do you handle money physically? If you frequently deposit cash or paper checks, a traditional bank is almost non-negotiable as a primary account. If you're paid via direct deposit and rarely touch cash, you're a prime candidate for going fully digital. 2. What is your technology comfort level? If a sleek app that lets you manage everything from your couch sounds like a dream, online banks are built for you. If the idea of troubleshooting a login issue through a chatbot fills you with dread, you'll value the human support of a branch. 3. What specialized services do you rely on? Make a list. Do you need notary services, safe deposit boxes, or instant cashier's checks more than once or twice a year? If yes, a physical bank in your toolkit is essential. 4. What is your primary goal? Is it to maximize every single dollar in interest, even if it means a little inconvenience? Or is it to have the simplest, most stable, human-supported experience, even if it means leaving some potential earnings on the table? And 5. Are you willing to adopt a hybrid model? Acknowledging that you don't have to choose one or the other is perhaps the most important realization. Can you manage 2 accounts to get the best of both worlds? The rise of online-only banks is not really about the death of traditional banking. It's about the dawn of consumer choice. For decades, we had limited options, and the big banks had little incentive to offer better rates or lower fees. Digital banks changed the game. They introduce fierce competition that is forcing the entire industry to evolve, and the ultimate winner in this battle is you, the customer. We're seeing traditional banks improve their apps, reduce their fees, and even raise their own savings rates to stay competitive. The future of banking isn't a world where one model vanquishes the other. It's a world of hyper-personalization, where you can and should build a banking system that is as unique as your own financial fingerprint. Whether that's fully digital, proudly traditional, or a smart hybrid of the two, the power is now, more than ever, in your hands. The question is no longer, which bank is the best? The real question is, what banking strategy is best for me? And now you have the framework to answer it.